Hello and welcome to yet another instalment of our Nucleus Wealth Insight series. Just a quick reminder that the following presentation is general information only and does not take into account your personal circumstances. Whilst Nucleus Wealth aims to present informing and sometimes entertaining content, please consult your investment professional, financial advisor, or better yet, speak to us before making any decisions based on any of the themes discussed in today's presentation. And don't forget that this is a live presentation, so feel free to drop any questions you like in the chat box below and we can answer them along the way. If you're watching this after the event, make sure you attend the next one so you too can participate in the live Q&A section of our presentation. Our presenters today include myself, Tim Fuller, a certified financial advisor who's worked with hundreds of clients over the years, helping to make the complex simple for companies such as AMP, Mercer, and independent advisories. We also have David Llewellyn Smith, co-author of The Great Crash of 2008 with Ross Garnaut, founder of the internationally acclaimed Diplomat magazine, and now chief editor of the enormously popular Macro Business Financial blog. Finally, we have Nucleus Wealth's Head of Investments, Damien Klassen, whose 25 years in the world of finance has seen him as the founding partner and head of research at analyst firm Aegis Equities, head of quantitative strategy at Wilson HTM, and was responsible for mining, energy and big data in the $60 billion global quantitative equity fund at Schroders, who are a multinational asset management company. And for more information, please check out our people section at www.nucleuswealth.com. Yes, so hello and welcome to yet another instalment of Nucleus Investment Insights. And this week we've entitled it The Nervous Investor. So we put this one together, I guess, on the basis of a bit of feedback from some current and I guess prospective clients in regards to what's being done given current market conditions. Pretty well known that markets are typically fairly full valued at the moment. And so what else is being done from an investment standpoint in our portfolios and the way we view things in ways to protect clients' money and clients' capital. So we'll jump into the agenda. So we thought we'd kick it off with the perennial question, who is the enemy, in terms of being cautious or being worried about investments in general. Then we'll jump into some key tips and also assets to invest in and the way that we position client portfolios given current market conditions, their own risk allocations as well as they come through, and a little bit of explanation around those assets and why they're useful and why they're particularly relevant in markets like today. So let's kick it off. And I'm joined here in our studio with, of course, our Head of Investments, Damien Klassen. G'day, Damien.
Hi, Tim.
And so we might start off with quite an interesting one here. Who is the enemy here?
Yeah, sure. So look, I mean, I think the key thing for to sort of bring out of this is that if you're a nervous investor, you need to sort of recognise the environment in which investment's done. So on average, retail investors, so sort of a mum and dad investor, considerably underperforms the stock market. Now, part of that is part of that's due to the fees, part of that's due to sort of trading costs and things like that. One of the largest parts, though, for that, one of the largest issues is that people tend to buy at the top and sell at the bottom. So it's exactly the sort of opposite to what you'd expect, and it's that whole fear and greed that sort of goes on and off. And so, as a nervous investor, if you're sort of coming into this saying, look, I'm quite fearful and I'm worried about whatever the events of the day are, you sort of need to recognise that this is a typical situation, and that this is typically why people tend to underperform, and there's a bunch of strategies you can use to try and get around that and try and you improve your investment performance and also decrease your stress levels.
Yeah, sure. And I guess essentially it's one of those things where you're saying it's a very emotionally driven sort of environment, isn't it? When you've got your own money at play, you've worked hard, you've saved, you've probably foregone some some various luxuries in life or bits and pieces to get to where you are, and then so at the end of the day, it's paramount that you make some sort of decision, but when and how is the question?
Yeah.
Okay,
Yeah,
sure.
Absolutely. So the one I popped up here, just investing in what you know. So this is a pretty common one that sort of I get from a lot of investors who are talking about saying, well, I know all about this type of thing, and so this is what I should invest in. That's a stock picking advice. So it's not advice for asset allocation and sort of broader wealth. And that's where I think a lot of people, in terms of being nervous, if you're nervous and you're trying to think, well, I need to invest in what I know, and I'm about to buy international equities or government bonds or whatever it is, and I really don't know that much about it. Maybe I should just stick to what I'm good at, which is a particular industry in a particular sector or things like that in the stock market. That's where you get some quite significant volatility in terms of your investments. So asset allocation, if you can sort of flick to the next one, asset allocation is actually absolutely about diversifying and investing in things that you're not quite sure about, trying to get the level where you can try and work out, well, I know how these, if you have something around about it, that's great, but that should be your entire portfolio. You should also have all these other assets to actually give you assessors or new regulations come in or whatever it is. You haven't tied all your wealth up into just one or two companies.
And I guess and that, for mine, it comes down to potentially an issue of time then, because you know something you know about, as you mentioned before with that example. You know a certain area, you research it, you know a good company from a bad company in this one very discrete area. You invest in it, and then you get on with your day because you're not a professional investor.
Yeah,
and you've got other things to do with your time. And so you're saying now that instead, of course, this is the move to asset allocation is the key from these.
Absolutely, it's all about diversifying, and that's going to reduce your risk.
Okay, sorry about that small break there. We'll have to edit that one out for the podcast, but I think we've got our tech back in check. So we'll jump into this slide here, the wall of worry. So having covered off on the biases before, Damien, what exactly is a wall of worry? So the key thing with the wall of worry is hindsight's 20/20. So every year, whenever strategists go to write their next version of the what to expect from 2018 and what to expect from 2017, there's always this hindsight bias that last year was inevitable, easy to pick, and that whatever happened was guaranteed to happen, as opposed to being a some sort of probability of events. So what and you see that in all the types of people backtracking their let's say the Trump election, for example, backtracking the views about beforehand was, no, this is unlikely for him to be elected, and then afterwards, well, it was always obvious this was going to happen, and given the Midwestern states and all that type of stuff, there's a lot of hindsight bias where people put things in that make it look as if this was guaranteed to happen, but the future's now going to be more difficult. And that's the way you write if you're a strategist, that's the way you write stuff, is that last year this happened and that happened, and I told you something was going to happen, and that's why I did, and I was perfectly right. But next year's going to be more difficult, so listen up, or it's a stock picker's market. Last year was easy, you just bought US stocks and whatever you bought went up. This year's more difficult. I need to come back to what is going to go up. And so there's always something to worry about in terms of investment. So if you're a nervous investor, you'll always see the newspapers, having a negative story about why it's dangerous to do it now, why the markets might crash. Those types of stories are always out there. There's a bunch of perennial bears who always call crashes. They call them consistently across time, and then when they happen, they pop up and say, "Look, I told you everything was terrible. I'm right." And the fact you would have lost an incredible amount of money following those people, but they're then the people, the press, when markets fall, the press turn around and go, well, we need a comment from that guy who made all those bearish predictions, and he was right. And the stop clock was right for a change. Exactly. And so there's this wall of worry that's always there. So if you're a nervous investor, get out of the financial press, because you're going to see, that's what you're going to see all the time. Yep. Is these concerns and worries and things like that. You need to come up with a strategy that you're going to stick with, but the financial press is very unlikely to help you in that case. And you need to work out, are they selling you a newspaper or are they selling you investment advice? Yeah, sure
because,
thing. And I guess that's one of the key things, isn't it? We'll move into the various assets that can be looked at. But there's always a sector or an asset class in vogue for bad news, which is obviously going to get the most eyeballs, isn't it? Right?
Yep.
Would you say? Yeah.
Yeah, absolutely.
And it's not like you ever see a headline press thing saying, "Oh, guess what? Government bonds paid 3% last year," and
yeah,
chip in. So fair enough. Okay, great. So look, let's fire into the asset allocation piece. So in practice, what we've got here is a range of different, instruments and asset classes that can be used in a portfolio. Do you want to just run us through these here, Damien?
Yeah, I'll just stick with a quick overview, and then we're going to jump in and talk in more detail about those assets. So the first bit is the cash and term deposits. So this is generally sort of in a relatively the most risky to the least risky to the most risky. So cash and term deposits, which is I think most people are probably on top of, your government bonds, where basically the government has got these securities where they will redeem for $100 and they'll pay an interest rate, and that interest rate is fixed in time. So the good things with the government bonds is if you've bought these, and usually we sort of buy them in a bit of a ladder, so you've got your bunch of them, is that you know what your income is going to be over the next few years, and you know what your returns at the end of the period is going to be.
Sure.
And that can vary from to some of the corporate bonds, where quite often they're on floating rates,
Okay.
and they also varies to cash as well, where the amount you get goes up and down. So if you're an investor, well, actually we'll move on to that. We'll go into more detail on those.
Yeah, sure.
Then you've got your stocks, which is a lot more volatile. You usually get more growth out of the stocks, but the ride's a lot bumpier. And then a few other assets that most people are sort of include in these, whether it's currency, gold, or alternative assets, and we'll go into those in more detail.
And so, just before we jump into the cash and term deposits in detail, so is one of the issues, and this is sort of I think from my own experience as well, where people seem to view asset classes as sort of quite binary. I've either got a cash or a term deposit, or I've got shares. Would you agree with that? Do you think that sort of do you often find that the sort of the bonds and that sort of those middle ground there is available or used that much by the retail market?
In Australia, that's very much the case.
Okay.
So overseas it's not as much, and you also find the more you get through, the more people have been through with planners and professional investors, the more likely they are to sort of have filled out their portfolio.
Okay.
But yeah, absolutely for the some of those self-managed super fund stats that you get out, especially the low balance ones, it's a 0 or 1.
Yep.
I'm either in cash earning almost nothing and no chance of upside or downside, or I'm in stocks with a big chance of upside and downside, and there's sort of nothing in between.
Yep. Okay. Yeah. Sure thing. Okay. Great. So that leads us into the first deep dive. So we've got cash and term deposits first up. Some upsides of cash and term deposits.
Yeah.
Damien?
So I mean, look, your biggest upside always is that you're fixed in terms of you know what your balance is, and that's not going down.
Yep.
So flip side is there's no, it's not going up either.
Yep.
You get an interest payment, but the actual balance you've got, it is what it is. And so the downside to that is when you do see big rate cuts. So if you're living off that money, I think there's many pensioners who sort of lived through the financial crisis and saw that whole issue of as interest rates came down, they went from going, well, I'm living quite comfortably on a 5% interest rate on the cash I've got.
Sure.
And then pretty much overnight, you were a month, two or 3 months later, you were lost 2 or 3% off that. And then as the crisis got worse and worse, your income got lower and lower, and now you got to start digging into your capital. Okay. So the issue, so that's your key issue with cash. I'll sort of toss across to David, sort of in terms of cash. In terms of the
what are the highlights and lowlights? So I'll welcome our chief strategist who's come in, David Llewellyn Smith. How are you?
Hello. Hi guys. I've just been
put on the spot.
I've just been stuffing myself with popcorn as the Australian Parliament falls apart. So I'm a little late to the podcast, but forgive me given the levels of drama. So yeah, cash. Well, I guess I would talk about what it's doing right now versus what it does in theory, and that is, interest rates are very low. We're in a regime of financial repression, where what central banks are trying to do is bail out indebted people with inflation, and they do that by suppressing the interest rate for savers. So at the moment, if you're in cash, you're really kind of taking it for the team. And there's not a lot of prospect of that improving for savers in the foreseeable future. In fact, it's probably the opposite.
Okay.
Where interest rates will keep falling. Our view is the RBA will be forced to cut again next year, so the banks will keep some of that for themselves, and they'll squash the depositors as quickly and as effectively as they can. There's also rising funding costs coming from their market-based liabilities, which is the non-deposit area of the bank, but they can actually squeeze the depositors to help offset some of those climbing costs as well. So right now, as Damien said, you get a dividend out of cash or an interest rate, but the prospects for that are already pretty lousy, and they're going to fall further.
Okay. Yep. Positive as always there, mate. Fantastic. love your work. Yeah.
Well, it's one of those things. Sometimes people call me bearish, quite often, in fact. But if you read a bearish trend right, then you can actually make a lot of money out of it.
Yep.
So
that's a great point.
Yeah.
Yep. Fair enough. Okay.
I actually don't think there's any such thing as a bear or a bull.
It's just a realist.
Well, there's just stuff that goes down and up, and you can actually make money either way.
Yeah, absolutely. Although I would hasten to add that I do think there are people who are permanently bearish and permanently bullish.
Oh yes.
But don't mistake people who are bearish for periods of 3, 4, 5 years at a time. That doesn't necessarily mean they're always bearish.
Yeah.
I think that's probably where
that's
David
right.
would come back to, saying people talk. I think in some financial markets, perma bears are considered people who are bullish for longer. Sorry, bearish for longer than a couple of weeks at a time.
Yeah.
At the stockbroker's job is to sell stocks, and so it's great to have a bullish story and a bearish story, and you trot out one for a bit and the other for a bit, and you bounce back and forth. But as an investor, you need to take a longer term time period, and as an investor, you don't get paid for churning your portfolio. It's actually the opposite. So you need to take that in mind as to when you're looking at that financial news I was talking about.
And I guess you just hit on a good point there that as an investor with a mid to long term view, and touching on Dave's thoughts there, is that cash is really just a safety option at this time, and it's not going to pay you in the long term. It's not envisaged that it's going to pay off in the long term.
No, having said that, we have lots of cash in our portfolio at the moment, but it's a tactical choice, and it's certainly not a long term choice to have.
Sure.
To that much.
Okay.
Yeah, I mean, it's certainly safe. I mean, you could argue it can be at risk when you get very extreme conditions for your banks, and financial crises and what have you, or big asset devaluations or debt deflations.
Yeah.
And in those circumstances, sometimes there are bail-ins that include depositors taking haircuts, but as we've discussed previously, we think that's extremely unlikely in Australia. I think politically suicidal.
Yep.
And the budget is in good enough shape for it to absorb the kind of even a nasty housing shock. Certainly, when I say absorb, I mean absorb with a series of sovereign downgrades and a lot of pain, but absorb that hit without having to go so far as to bail in depositors.
Yeah.
Yep. And that was effectively what we saw in Ireland. Was the government had balance sheet that wasn't too bad, had a massive housing crisis, banks that were all couldn't afford to pay, and so effectively the government just bailed in. Yep. Bailed out all the banks, and now the government's got a large debt balance, and on it goes.
Yeah, sure. Okay. Interesting. All right, so let's while we're on the topic of government debt, let's roll into government bonds. We sort of mentioned before, but this is probably a potential new area for your average investor who, as we said, may be just falling into that binary cash, term deposit, or stock sort of decision they're making. So maybe we kick off with a little warmer up on the government bonds, and what they are and how they can be accessed.
So two key points, two key types of bonds. One is inflation linked, and so you start off with $100. So you give the government $100, you'll then get back $100 plus whatever the inflation's been.
Okay.
And you'll get an interest rate along the way that is based on the. So you'll get a sort of a 2% yield, for example, on your bond. So it starts at you get $2 on your $100, but then that $100 goes up, and you get a slightly higher dividend as time goes on.
Okay.
So it's good in terms of if you're worried about inflation. The big issue with them is they don't pay very high dividends because of that. Because the dividends are increasing, you get much lower dividends than what you get in a normal bond.
Okay.
So if you're worried about inflation taking off, and we're not worried about that, then you have lots of inflation linked in your portfolio.
Sure. We've
got a few in there just as it's a good hedge to have.
Yep.
It's nice to have a few of those sort of lying around just in case. But most of the bonds that are issued are non-inflation linked. So what will happen is that bond will get issued at $100. It's redeemed for $100, and let's say some of them are paying a 4% interest rate, which is considerably above the current rates. So what will happen is that bond will actually go up in price, so that the 4% becomes the 3%, turns into 3%. That's so you'll pay more for that bond, so your actual yield over the entire period will be come back to 3%. But the key part is the dollars you are getting are fixed. So the key thing especially for a nervous investor and anyone who was sort of hit by this, only had cash and term deposits, and then the market, the interest rates tumbled, and all of a sudden you don't have enough income to meet your day-to-day needs. That's where bonds are good, in that that same decrease in interest rate occurred in bonds, but because your interest payments are fixed, you get that over a long period of time. So you will actually end up eventually, so if interest rates fell from 5% to 1% and then stayed there, eventually you would end up with the 1%, but it'll take sort of 10-15 years for you to gradually go down and most of the people will sort of have some sort of what you call a bond ladder. So basically I'll have some bonds expiring in 1 year, and when they expire, I'll go and buy some 12-year bonds on the end of it, and then my next set will expire, and my next set will expire. So as each one expires, you'll gradually get lower interest payments, but it's a gradual process. It's not like the cash account where it happens instantaneously.
Okay, sure.
So if you're a nervous investor, bonds are very good for that. And the other thing is that, look, your bond value does go up and down, but you're getting that $100 back at the end of it. And I'm talking government bonds here. So there are some issues about will governments pay back the money or not pay back the money. The net result, though, again comes back to there are very, very few cases where governments have defaulted on domestic investors. Most of the time when defaults happen, here's some foreign investors who gave us some money, they don't vote, and so if we default on those bonds, we're not too bad. Well, sorry, it's not good, but there's less repercussions than if we default on people who live locally who have given us money.
Okay.
So you're pretty certain you're getting your money back. You know what the value is, so you're not going to lose capital, or if you're losing capital, you know ahead of time how much you're going to lose. And your interest rates are fixed. They're very, very steady form.
And so I guess then it lends to the question, and just sort of getting on the other side, I guess, of the microphone here, but for an average investor who goes, okay, that's great, Damien, that kind of sounds like a term deposit. I give a person $100, and then at the other end I get $100 back, and I get 3% rather than 4%.
Absolutely.
So what's the point of then why would I bother with a bond? Yeah.
Okay. So the tricky bits is there's two parts to it. One is it lasts a lot longer. So your term deposits, you can get some 5-year term deposits, but it's pretty hard to find big amounts that you can go. So you can get government bonds sort of 15-20 years in Australia. Overseas you can get to 100-year bonds in various markets. But
that sounds handy.
Yeah, well, and perpetual actually in the UK. But you've got longer periods. The other thing is you can sell your bond when you need to. So, and especially when markets go the other way. So what tends to happen is stock markets fall and the price of bonds goes up, and now I've got my bonds sitting there. I can sell those bonds and flip back into the stock market at maybe not at exactly the bottom, but much closer to the bottom than when you first bought them.
So typically, as you said, like in a big market fall, in a stock market fall, then people are getting out, heading for the exits, looking for something to put their money into, and then naturally the bond market's the next most available.
Yeah, absolutely. So you're worried about the bottom falling out of the stock market and thinking, well, if it does, then I'll go and buy some stocks. If you go to stick your money in a 5-year term deposit, and 2 years into it, the bottom falls out, and you're sort of sitting there going, well, do I do, there's a big break fee, do I lose all my interest or whatever it is, or can I get my money out at all?
Yep.
Whereas the bond, you're just like, great, go and sell the bond and now go buy whatever else I want.
Okay, all right, very good.
And I'll just add a little bit of context for today on bonds as well.
Sure.
We're actually really bullish on Aussie bonds at the moment, thinking about buying some more. We already hold some. So the reason for that is that we see the Australian economy slowing, and there is a relationship between the bond yields and the cash rate set by the central bank. As the economy slows, as we see it, for various reasons, the RBA will be forced to cut, we think, next year, especially because of house prices falling and then sort of emerging interplay between that and the chaos in politics. And so that's going to lead to bond yields falling sharply, and therefore the price of those bonds rising. So at the moment, Aussie bonds actually look like quite a good investment.
Okay.
That's in the sort of medium to short term, but then when you start to factor in how late cycle it is globally, then there's a fair argument that we might be able, that those travails in Australia may segue into something more difficult for the global economy before too long as well, and so again, those Australian bonds recommend themselves.
Okay, yeah, very good. So we've got a chart up here now.
I might jump to the correlation one, actually.
Yeah, sure.
So this is just a correlation of government bonds versus stocks. So in Australia, this is a US chart, just over a very long period of time. And so what it's showing you is so a correlation basically means if one asset goes up and the other one always goes up at the same amount, then they've got a correlation of 1. If one asset goes up by $1 and the other one goes down by $1, then they've got a correlation of -1.
Sure.
And then somewhere in between is where it sits with these. So you can see that that there's not much correlation, so it's quite low, 0.25, maybe a couple of times it spiked to 0.5 is the highest correlations you get.
Okay.
Generally speaking, the correlations are much lower than that, and the last sort of 10 or so years we've seen negative correlations with government bonds. And so, and that's something we're expecting to continue for probably a range of reasons, which, again, we could probably spend and probably have already spent a whole podcast talking about these issues. But so we are expecting that negative correlation, which means that we quite like them as an opposite side. So if you're expecting the assets, two assets to go up by 10% over a couple of years, and you can buy ones that aren't correlated, then it gives you a much smoother ride, because one asset's rising, the other one's sort of falling or going sideways, and then the next thing it's the second asset's turn and the first asset's falling, and it gives you this nice sort of smooth ride. Whereas if you just doubled up on one of those assets, you get quite a bumpy ride, because you're up a lot and then all of a sudden you're down a lot, and
And so in a sense, for a more sophisticated investor who has access, well, not so much access, because these are available, traded on the Australian Stock Exchange.
Yeah, listed on the Stock Exchange, and that's actually probably one issue it's been very badly marketed. So it used to be that you'd need to buy bonds in $100,000 lots, which obviously reduces the number of people that, and that was sort of that's sort of a 20-30 year thing, so that obviously $100,000 20 years ago was a lot more than it is today as well. So whereas now you can actually buy as little as $100, you can buy bonds on the ASX listed. You got to pay a brokerage fee on it, but so you don't, generally speaking, because bonds have got low returns, you don't want to be trading in and out of them too much.
Sure.
But they're there. They're very available for any investor to buy.
Okay. Yep. Very good. And so, and just finally, before we move off government bonds, but this is the domain of what we do at Nucleus Wealth in our
Absolutely. Yeah. So we tend to try and deal in. So Nucleus, the idea of Nucleus is that we're dealing with people's core assets, so sort of the assets that sit in the middle.
Yep.
And we're going with the safe assets, cash, bonds, and large cap shares, both in Australia and internationally.
Okay.
With a view that then you can buy more interesting assets yourself around that if you want, or you can just go with that sort of core safe assets sort of sitting in the middle.
Okay, sure thing. So that's government bonds. We'll jump across to corporate bonds, and we might just have a quick run through of what these are, how they're available as well, and why they're not perhaps in our portfolios.
Yeah, sure. So very similar to government bonds in that they a lot of them are fixed and they pay that same. You give them $100 and you get the money back at the end. The issue with corporate bonds is that the default rates is that, okay, now I've got a much larger chance of this company going broke.
Yep.
And when they go broke, I won't get back all my money.
Okay.
And so
essentially, unlike a government that can print their way out of trouble if in a bind, if everything else goes to hell in a handbasket, not so available for a company. Okay.
And so
companies don't issue their own currency, basically, except for some Bitcoin currency.
All right, let's stop that there, and let's just stay on track. All right, very good. So, corporate bonds, for those that did want to have a look, though, ASX listed.
There's some that are ASX listed. The Australian corporate bond market is very small, and most of it gets done off the ASX. So, and so most of these are off market, which make it more difficult for people. So people tend to buy corporate bond funds. And I think the part of the reason why the corporate bond market is sort of quite small in Australia is a mixture of franking credits and some tax issues in terms of that. In that it's and there's quite a well-developed US market.
Right. Yep.
And so often Australian companies that want to raise debt in the corporate market will go to the US market to do so.
Yeah. Okay.
So you find that the US market's got a quite deep corporate bond market.
Yep.
But there's certainly it's much harder to buy in Australia and much harder to buy diversified portfolios. There's an exchange traded fund that's out there that pitches itself as a corporate bond fund in Australia.
Okay.
But has only basically I think it's got maybe 6 or 7 stocks in there, and I think 4 of them are the major banks, and so you basically you're not getting a corporate bond exposure. You're getting more leverage on the Aussie banks.
And so just before we jump off again, obviously one of the things that's somewhat grown in popularity over the last decade or so have been hybrids, and that CBA Pearls is one that you see floating around from time to time in people's portfolios, and no one really knows what they are. They sort of feel that they're safe, and they pay generally quite a significant coupon, or not really a coupon rate, but a dividend.
Yep.
Do you want to quickly run through your thoughts on hybrids?
Yeah. So hybrids. The important thing to note with hybrids is that hybrids are a product that gets sold to the retail investors. So professional investors very rarely buy hybrids.
Right.
There's lots of professional stockbrokers who are happy to sell them to people, but because for them it's a way of saying, well, if you stick your money in the bank account, then I don't get any cash. But if I can get you to buy some of these hybrids, then I can get some of my trading up and running, or I can get you into my portfolio fee or whatever. So, that sort of should set off some red flags straight away for most people. Is it just well, why don't the professionals buy these? And it's because in the end, with a lot of hybrids, I like to joke about it, but it's you get all the upside of debt, which is none.
Yep.
And all the downside of equity, which is you can lose your much higher chance of losing your money.
Can go to zero.
So you basically sit. So if something goes wrong with a company, you start going through, and the employees get their money, and then the suppliers get their money, and then if there's anything left, it goes to debt holders, and if there's anything left, it goes to the next sort of junior debt holders, which is where these hybrid guys sit.
Okay.
And anything left over after that will go to the equity holders. So debt holders on average, I think the average recovery rate is something like 40%.
Wow.
For a debt holder. So if you're a debt holder and you give somebody $100, give a company $100, and something goes wrong, on average you'll end up with about $40 back, which means the next level of the hybrids, which are below you, on average don't end up with money.
Yeah, right. So, and then hang the shareholders at the end. So
yeah, that's right. The shareholders are
done and dusted. Okay, very good.
I'll just add one key difference then, because of what Damien's talking about with the high default rates and risk that you get with corporate bonds, they can't be used in the same way as a hedge for a portfolio, because when times are tough, quite often corporate bonds will fall as opposed to the government bonds, which will rise.
Yep.
Yeah, absolutely. That was the financial crisis, a great example of that. The textbook corporate bonds got smashed. So all these people sitting with hybrids who went, no, I'm safe, I've got hybrids, and then all of a sudden their $100 hybrids trading at $60. maybe the equity had gone from $100 to $40 or $30.
Yep.
But so you're like, oh, I did much better than I did in equities, but like you were still down a lot.
Yeah.
Whereas the government bonds went up in value.
So yeah, essentially whilst they paint themselves as a defensive product, they're really fully growth.
Yeah, that's right. So yeah, so I guess they've got a place in larger portfolios for corporate bonds, but I wouldn't describe a corporate bond as a must-have. And if you're a nervous investor, then corporate bonds is playing with fire, because you're going to, when times are good, you're going to be sitting there going, why am I only getting 5% on this corporate bond when everything else is up 10, 15, 20%?
Yep.
And when times are tough, you're going to lose money on them.
Yeah, right. Yeah, fascinating. Okay, very good. So we'll jump now into the last of our big four asset classes, in of course being stocks or equities or shares.
Yep.
Let's just do a brief one on this one. I think it's probably fairly well known.
Yeah, so lots of upside, lots of downside is probably the pithy summary of it. So typically, you actually get very few years where stocks sort of churn out their average performance. So most of the time they're either giving you sort of double digit and above performance, or they're coming in with negative or very low performance. So very volatile in terms of the returns you get, and so you need to have a longer time frame for it. The other thing is you do get a lot more individual events within stocks, so you do need to make sure that if you're a nervous investor, diversification is key. And there's plenty of cases where things that seemed relatively certain at some stage were a few years later had blown up, or everyone had, what was a no-brainer investment, what seemed like a no-brainer 3 years later, people were saying, well, only people with no brains actually invested in that thing. So there was sort of this thing called the Nifty 50, which was in the US, where there was basically all these stocks that were like no-brainer stocks to buy, that were all the latest and greatest stocks, and these, you just buy these and forget about them, and they'll always go up, and the performance of that Nifty 50 was terrible. So whenever everyone sort of comes back and finds a secret source, it's unlikely to last.
Okay, sure. And just finally, and this is probably a question that hasn't come up yet on the live chat, so I'll throw it in here though. Without a doubt, the common theme at the moment is markets are fully valued around the world. What would you say if a person said, well, why should I even be in the stock market at the moment, given that all the press says that everyone's paying up, there's high PEs everywhere. As an equity investment house that you are, why are you in equities?
Sure. Well, partly you could have made that same argument a year ago, and US markets our international portfolios are sort of up 20% plus in the meantime. So you are getting to the more dangerous end of it now. So, but quite often this is where you get the irrational exuberance. Okay. And so there are good returns, and the other thing's that wall of worry is that there's if we're looking at extremely good EPS growth, or earnings growth in the US at the moment. It's sort of 20% plus for a lot of stocks, and I think the average is well over 15. So in that type of high growth environment, if you then get China, big stimulus comes out of China, Trump manages to hang on to power and also adds an infrastructure boom, you could see another couple of years of quite good growth. So even if the valuations of stocks didn't move, so I'm paying a high value for the stock, but if the earnings underneath that are growing at 10-15%, then you're actually going to get a great return on the stocks. Okay. So there was earlier on in the year there was more of an issue. So and that's, I guess, it sounds strange to say that the stock market was a bit lower, but there was a bigger issue at the start of the year because we hadn't actually seen all the earnings growth, and so the stock market's sort of gone up a little bit, but earnings have gone up a lot, and so that's meant that the what was quite expensive at the start of the year is now actually a lot more reasonable in terms of the not a lot more, that's overstating it, is more reasonable. It's certainly, if you bought today in a lot of markets, you're buying at a cheaper rate than most times over the last 3 or 4 years. and stock markets have had a pretty decent run over the last 3 or 4 years.
Okay, yeah, sure, great answer. We'll jump into one of the subsets, I guess, of the asset allocation world, being currency. And I'm not sure who to handball this one to first.
I'm going to handball it to David. I just want to say one thing before we do, is that the benefit of most of these other things we've spoken about is in general you make money. You stick money in cash, in general you make money. You stick money in bonds, in general you make money.
Yep.
Same for stocks. In currency, by definition, there's one winner and one loser. If your currency is going up, then someone else's currency is going down. There's a little bit of a friction in the middle of brokerage fees or transaction costs.
They're making money.
So they're making money. That's right. They're the ones who always make money. So a currency bet over the long term, or especially lots of active currency trading, is a losing bet.
Recipe for a hiding.
Yeah. It's like playing your black or red at your casino on your roulette wheel. It's great. You got about a roughly 50-50 chance, but the house knows that there's also a green that comes up 1 in every 36 spins, and so they take that. They take that clip, and on average, the punters lose out, and that's where I see currency. There's definitely some benefits, and it really helps in a few cases, like right now. But in aggregate, a currency is not a winning long-term investment. Okay,
sure. Well, on that foundation, David, have you got anything to add given your insights in the macro business world?
Well, I agree with that. That said, I think over the long term you can gauge winners and losers in currency, which I know a lot of people will bridle at, but the underpinnings of the value of a currency are well known. So if you know what they're doing and where they're going, or at least where data's suggesting they're going to go, then over the long run you can have a reasonable they're reasonably reliable in terms of where they'll end up. That said, there are extraordinary numbers of variables in currencies because what Damien is talking about, where there's one winner and one loser, you have to actually understand both sides to know which is which is the winner and which is the loser. So you can't look at the Australian dollar versus the US dollar without knowing both currencies, both countries' economies, political economies, global circumstances extremely well. So it becomes, a Herculean task understanding all those things at once.
Yeah, sure, that makes sense.
But they can be useful, and right now the Australian dollar certainly is, in terms of having international exposure, and I remain still very bearish on where the Australian dollar is going to go, simply because our circumstances are such that we need a lower currency, and that will happen one way or another over time.
And so that's good for you if you're investing internationally, just to put that in context.
Yeah,
so
that's right.
If you buy a dollar's worth of, you buy a dollar's worth of US dollars, and it costs you $1.30 or something like that at the moment, and the Aussie dollar falls. Okay, now my that dollar I bought in the US is now worth more in Australian dollars.
Yeah, that's right. And the drivers behind what we think is a bit of a secular decline in the Aussie dollar is by and large it's China is the key player in it. We've been calling this since 2011 when we were right at the top, and the story hasn't changed. That is that China confronts a secular slowdown, and every few years it gets too much for them. They stimulate, you get 18 months of good growth and the Aussie dollar rises 10-15%, but the overall trend remains down for China, owing to structural problems that they've got in the economy. So they're not going to change, and so that means commodity prices will grind lower, and so will the Aussie dollar over time.
Okay, yeah, sure. All right, great outlook. Well, yeah, great insight onto that outlook.
Well, as I say, if you're not biased, bearish or bullish, and you just accept prices rise and fall, you make money either way.
Yep.
And the good thing with the currency from an Australian perspective looking out is that it is a hedge on growth. So the market grows well, and the Australian dollar will probably rise a little bit, which will reduce your returns, whereas you go into a bit of a crisis and you see stock prices fall, the Aussie dollar will often fall as well, which will offset a lot of your losses.
Okay.
Well, I think it's fair to say that it always falls. So you know, when
I'll take mostly.
yeah, well, I suppose it's a good idea to take mostly, but but the truth is, it does nearly always fall when there's a serious risk to global growth. You know, because of that commodity exposure, by and large, because those prices simply collapse when there's no demand. So, you know, the Aussie dollar in that sense is structurally like really useful to an Australian investor.
Yep.
You know, because you can use it as a fabulous hedge if you're invested offshore.
Yep. Okay. Fair point. We'll jump across to another mainstay of the conversation, and that's of course gold. Speaking of what some people would think is a natural hedge to markets and volatility. Have you got much in the way of light to shine on this one, David?
Look, I'm going to take this one, yeah, because I'm having this conversation all over the place at the moment. The gold's really pretty ironic, which may sound a bit wacky, but it attracts the most nervous investors of all. You know, because it is the ultimate safe haven in the sense that if there's a systemic accident, then, you know, gold is what you want to hold. So you really are hedging against the worst case outcome in holding gold. It's like, you know, building a concrete bunker under your house that will survive the nuclear holocaust, or the you know, the coming of the zombies.
Sure.
So, you know, it's definitely useful as a portfolio hedge over the cycle, like over multiple cycles in that sense, and it is a currency as well in that sense. It's the ultimate hedge against fiat currency collapsing, for instance, you know, because fiat currencies have collapsed in the past. So gold is very useful in that way. The thing is, if you're a nervous investor, by going all the way and hedging against the apocalypse by being overweight gold, you are actually making an asymmetric bet, which is high risk.
Okay.
Because the Armageddon doesn't come along very often, is the problem, right? You know, so, you know, in the meantime, gold is very, very volatile. You know, in a cyclical sense, within the cycle, gold moves up and down a lot. And so you can be exposed to huge paper losses in gold, and if you're a nervous investor, that's the last thing you want to see.
Absolutely.
You know, you're looking for a smooth ride, so
or the apocalypse, I guess.
Yes, well, and so gold is the absolute opposite of a smooth ride, and this is the irony at the heart of holding gold if you're a nervous investor. So, you know, within the cycle, the best way to think about gold is that it's simply a US dollar hedge. You know, if one goes up, the other goes down. You can see that's represented in the chart that I have up there. And this is not a one-to-one relationship. It's based on what gold, you know, gold finds its measure of worth versus the degree of risk underpinning the reserve currency. So that means that if you've got, you know, things like quantitative easing and twin deficits and, you know, all the, you know, perhaps political volatility and uncertainty, sovereign risk, all of the things that underpin the value of a reserve currency, if there's a lot of that, then gold's going to rise, and it can just keep rising.
Sure. As
long as those risks are there.
Yep.
If the risks get worse, gold can keep rising. Even though the currency itself doesn't collapse, it might be falling at a lot lower rate. So it's not a one-to-one value, but it is, in trend terms, gold is directly inversely correlated to the underpinnings of the reserve currency. So if you think the US dollar is going to rise, gold is a shit investment.
You heard it here first.
Within the cycle.
Yeah, sure.
Unfortunately, for the nervous investor in particularly, the US dollar nearly always rises at the end of cycle accident. Not always, but very often, because so much of global speculation these days is funded in US dollars. When you get an accident and you get all of this appetite for risk disappearing, they all take the money back to the US.
Gotcha.
They pull it out of the higher interest rate jurisdictions and stick it back in the US and buy US bonds or something for a period of time. So it means that the US dollar, you know, repatriates, and everybody wants them, and so the value rises really fast and gold falls. So you get, you know, these incidences like we did in the GFC where gold was smashed during the GFC, right? Precisely when you want it to rally, it got clubbed, and even in Australian dollars, it got smashed.
And we're talking at the start, so eventually it rose, but
Oh, of course,
in the key parts
through the crisis, when you're looking for security, when as a nervous investor, you're looking for your portfolio to be able to not be correlated to that volatility.
Yes.
Gold is your worst enemy. So I love gold. Like, I'm a gold bug. I used to trade it, professionally. I used to live off the earnings. It's terrific. I think it's a currency. I think it's here forever and an underpinning for global markets. But you have to understand that within the cycle, it's disastrous if you're a nervous investor, and you got to know when to buy it. And the point that you want to buy it is when the US dollar is peaking, right? So you don't want to hold it going into the crisis. You actually want to buy gold during the crisis when it's getting crashed, getting smacked, getting beaten up. Then, of course, what happens is the Fed cuts interest rates, all of those things that I was talking about with volatility and the underpinnings of the reserve currency kick in, and gold goes through the roof. Now, of course, over multiple cycles, that may work out for you that gold will continue to rise. But also it may not. There are circumstances where you can imagine the US dollar being quite sought after, going into the future over a number of different cycles. I mean, if we have geopolitics unfold in a way where the US dollar has a premium on it, which is quite possible, then gold will not remain in its bull market. I mean, it's been in a reasonable bull market since 2000. So I mean, those are, I guess, the constraints of gold. I mean, as I say, I don't think it's a bad thing to hold long term over across multiple cycles, but I'm always very cautious about holding it for nervous investors as for within the cycle, because it does come at a price.
Okay, yeah, sure. And just a quick one, just to finish up on gold, but there is always that question between the AUD, USD sort of, so there's a currency sort of mix in there. Have you got something just in
there is, and the AUD combined with gold, so gold priced in Australian dollars, is less volatile. Okay. Because they move together.
Yep.
But gold always moves far more than the AUD. So if you're, that should tell you something in and of itself. If you're not into trading currencies, then you shouldn't be into trading gold.
Okay.
Because it's more volatile than your own national currency. So like during the GFC, as I said, gold, the AUD fell heaps, but gold fell heaps more.
Okay.
So there were big losses, even in Australian dollar gold.
Great point. Okay, very good. So we'll jump now finally into our last little cluster of asset classes. We've turned alternative assets.
Yeah. I'd like to just toss this aside a little bit, in that there's a bunch of assets in there. Some of them are more volatile than others. I think for the nervous investor, there's a whole class of whether you're trading commodity futures and things like that I'd say, well, they're quite volatile. You're best steering clear of. Sure. In terms of the it is worth noting though as well, there's an element of security you get from some of these alternative assets in that they don't reprice their assets very often. And so in a way, and we saw this during the financial crisis for a lot of things, like real estate's a good example. A lot of infrastructure private infrastructure as opposed to public ones, looked a lot steadier than they really were, just because they only price their assets a couple of times a year. So you could be sitting there, and if you're sort of the person who wants to sit and look and go, I had $100 yesterday, I've still got $100 today, great. Tomorrow I've still got $100. Some of these are great because they literally don't trade, and so the price might have done crazy things in the meantime, but you never saw it because they're unlisted. Yeah, sure. So so some of these alternative assets, as long as you know what you're buying, might actually help play into those, play into that for as a nervous investor, because you don't see what the volatility. Yep. But I guess research the asset class before you're doing it, before you invest, because most of them do have very similar levels of volatility you find elsewhere, and a lot of the things like real estate and some of the infrastructure stocks are generally a little bit safer. But having said that, most of the vehicles get a lot of debt applied to them.
Okay. Yep.
So you sort of say, well, if I start with 2 assets, and if they were both ungeared, that you'd have a similar level of safety. And then I just I start with the stocks that have got certain level of safety, and these unlisted ones that are a lot safer. But then I just gear up the safer ones until my risk is actually pretty similar to some of the stocks anyway.
Yeah, sure.
So you just got to be careful about not just what are you buying, but how much debt is involved, because some of those have some eye-watering amounts of debt within them.
Sitting behind the scenes. Okay, very good. Sure thing. So that wraps up our assets and in the asset allocation piece. We might move now into some key tips and takeaways from everything that we've spoken about today, Damien.
Yeah. So what I'm trying to do here, we've got 5 things that are worth noting for the nervous investor. The things you should be doing before you're investing, or if you're already invested, the things you should be doing now. So the first one is this self-evaluation. Is do you think you've got the temperament to make investment timing decisions? And what I mean by this is I ran through probably for too long some of the biases that people have, and also this part about there's the fear versus greed. Is that are you confident that you'll have the ability, unlike most other investors who tend to buy at the top and sell at the bottom?
Mm-hmm.
Are you confident you'll have that ability? If you are, then go for it. If you're not, which I think, especially if you are a nervous investor, then I'm guessing chances are you're doing it. You are nervous because you don't feel as if you've got enough information. And so I would say that you need to come up with this. You either need to outsource it or come up with a plan where you're saying, okay, here's my plan, and this is what I'm going to stick with.
And would you say there as well, in terms of self-evaluation, and I think this is particularly pertinent in the self-managed super fund sector, where you need to also evaluate your not so much your ability, but your time that you have to be able to give your net worth potentially, or your superannuation the experience it deserves, perhaps by putting in the effort and doing the research and following it, and on a daily or a weekly or monthly basis, and having that actual scope in your life potentially as an evaluation point. Would that make sense?
Yep, absolutely. It's that part about how much time it's going to take, and then so if you're picking something that's quite a low maintenance. Here's my strategy, this is what I'm going to do, I'm just going to add some money or whatever, then that might sit well. But if your strategy is to keep tracking markets and to follow this and follow that, and you've also got a full-time job and kids or grandkids or whatever it is to look after as well, then you can find that outside events can easily take your mind away for a week or 2 weeks, and that was the key time that something happened that...
Yep, that's quite scary. Okay, sure. Next one.
So regret minimization. So the idea with this one is that... one of the key things you want to try and get back to as a nervous investor is minimizing the level of regret you're going to feel with whatever decision. So you're going to get decisions wrong. Absolutely. You're going to buy at the wrong time or sell at the wrong time. So you need to sort of get, the first thing is sort of get a feel for this fear versus greed. So how upset are you going to be if you're sitting in cash and you turn up at a barbecue next year and people are talking about how they just made 15-20% sitting in the stock market and it's fantastic, versus the same situation is you invest in stocks today and you're sitting around the barbecue and you're the person who lost 10% and everyone else is talking about, oh, like, I'm glad I had my money in cash.
Yeah, sure.
And so really sort of taking a serious assessment of where you sit on that front, because that's where you'll need to use to work out, am I going to be sitting mainly in safe assets, and I just have to realize that I'm not going to be the guy telling about everyone how much money I made in my portfolio, but I'm also not going to be the guy telling people about how much money I lost in my portfolio.
Sure. Yep.
So, and I'm guessing most nervous investors will sit further down that category, and they're just happy to don't lose the money and just acknowledge that you're not going to be that guy. So don't feel sort of this fear of missing out when you hear about them talking about the gains.
Okay, sure thing. And just finally noted
don't invest all at once. Yeah, and so that's the other part of that regret minimization is if you're worried about stuff, well, don't put 100% all on day one. Just drip it in.
Mm-hmm.
You are absolutely going to get it wrong when you drip your money in.
Yep.
But hopefully your winners and losers will balance out. Whereas if you throw it all in on day one, okay, now I'm going to regret either. I'm probably going to regret something.
Yep.
But it could be, if markets then fall, you'll feel a lot more regret than if you just sort of said, okay, well, I've got, whatever it is, 500,000 to invest. I'm just going to stick 50 grand in a month or 50 grand in a quarter or whatever it is until I'm fully invested. But, you know, you've got your, you know, you'll miss out on the upside and the downside, but at least you're
averaging it out. Yeah. Okay, sure thing. So next one.
Yep. So then it comes back to asset allocation, and that really part is you got to get that strategy right and then stick to it. So once you've decided, and financial planners might help. We've got something on our website where you can go through and sort of see where you sit in terms of risks and return. But it's about saying, okay, once I've chosen that I'm going to be, say, 40% stocks and 60% bonds or vice versa, if this is my strategy and I think over the long term, you know, that's I'm going to be happy with that, then I need to do that and stick to it and not bounce around and go, wow, my stocks did really well last year, my bonds didn't do so well, it's time I should have put more in stocks, I've got to flip out, and now, you know, it was 40-60, let me dial that up a bit and get more stocks, because that's what the average retail investor makes that mistake all the time and almost always gets it wrong.
Okay, sure. That sort of leads in, I guess, to a little bit to our next one there, the self-control element.
Self-control, yeah. So self-control. So what I mean by self-control is that, you know, you do need to do this rebalance regularly. So as a nervous investor in particular, you need to keep coming back and going, well, if my weight is 60-40, you'll find equities will go particularly strongly. So last year, international equities were up 20-something%. Well, if I had, you know, a big chunk of my portfolio on that, well, now I've got a lot more. I had 60%, maybe I've got, you know, almost 70% now, and bonds might have only gone up, you know, 3 or 4% last year. So I need to then take some away from my equities and put it back into the bonds.
Yep.
And it will hurt because you're always taking off the asset that just performed really well. You're always taking away it, and you're always putting into some data the asset that didn't perform well.
Yep, sure.
And so, but getting that discipline to, whether it's quarterly or annually or half yearly, whatever it is, that discipline needs to come out as, yes, I'm doing this. I don't care how I feel about the assets and how I'm really sad to be selling whatever asset that I did that just went really well. You've still got lots of that asset, or you still have part of it as an asset allocation, but keep rebalancing back.
And so do you think, and this is sort of what would strike me as essentially having that plan, having that piece of paper or that set of you know, guidelines essentially that says, okay, I'm going to, you know, we're going to ride the winners and we're going to take at a certain time period essentially. You'd perhaps look at doing something like that, or would you set a percentage and say, okay, you know, if my Aussie stock portfolio is up 20%, that's my indicator, so to speak. Would that be?
Yeah, probably the easiest way is just a time-based one. Okay. Once a year, for example. Most of the time, portfolios don't move large enough for that. A lot of people just sort of go, okay, well, I'm going to do my taxes right in June. Yep. I'll work out whether I'm going to sell it just before June or just after June 30. You know, depending upon.
Do a bit of loss farming.
Yeah, well, you know, some years it'll be more beneficial to sell just before, and some years it'll be more beneficial to sell just after. But sure. You know, but if you've got that as a rough guide, that often works well just from an organisational sense. The way I'd run it if I'm doing more professionally is having some limits about saying, okay, well, once I get more than 3 or 4% outside my limit, then I'll actually go in and trim and do whatever. Okay. But for, you know, you got to realize the practicalities and all that. And part of what I'm saying is what I said, is don't watch every market tick. Is that if you're a nervous investor sitting there watching stuff up and down and, you know, 11 o'clock it was this and 12 o'clock it was that, whatever, is not going to help. Get back to your life, set your strategy, set your plans, go back to your life. Don't worry about every tick of the market. Yep. You know, just take into account these. If you've got everything right and you've got your strategy right, keep dripping it in over time. Is that eventually you know.
So in essence, set it up properly in a reflection of your long-term goals or your needs, and then have a bit of faith, essentially.
Yeah, exactly.
Okay, fine. And our last one there,
analysis paralysis. Yeah, got to do something. There's plenty of investors we speak to, and you know, we had plenty who's on day one, you know, turned up and were like, oh, I'd like to put this money in, but I'm not quite sure about this, and I'm not sure. I'm worried about Trump, what he's going to do, and I'm worried about these effects and whatever it is, and sat there and do nothing for a year, and you end up in the part of now you've just lost your opportunity for whatever it was, but also you know, by not having that disciplined, okay, I might be really worried about this stuff, so let me drip in a little bit, and I'll drip in some in 3 months and another in 6 months time or whatever. If you're just going to sit there and wait till all your ducks line up, you'll be still sitting there in 10 years time going, oh, I just need to, I'm just a tiny bit worried about something else somewhere. There'll always be something to worry about. And the danger is you're sitting there always worried about something, and you miss out on the returns you could have got on just a normal balanced portfolio, nothing special. But you don't want to be the one who's sitting in cash earning the lowest possible returns over a period of 10, 20 years, just because at every step of the way there was always something to worry about and always a reason not to invest.
And I think that sort of plays back into a comment you made earlier, where we sort of rolled through these various asset classes, and by and large the majority of them do make money over time, and there is a timing issue as always, but then you've got the ability to eke into the markets or eke into the strategy and move from a zero position or a cash position or whatever it is into something. So but I guess the key takeaway there is that it's better to do something now, make a decision, and then move from there.
Yes, that's right. As long as you're not investing it all in one hit, then you'll just eke it in over a period. Maybe it's 2 or 3 years you eke it in over, but get out and do something.
Yeah, sure. Okay, very good. So if you're looking at if you're thinking about doing something over nothing, here's some information about Nucleus Wealth. Nucleus Wealth and the Macro Business Fund was put together to help give you access to quality, well-researched stock analysis and superior macroeconomically minded asset allocation. We use technology to help us provide a service typically only available to high net worth and sophisticated investors at a fee level that rivals the more basic solutions available to these everyday investors. We do this by using separately managed accounts, which allows clients to enjoy unparalleled transparency in what they own and why. It also means that each client effectively owns their own separate and discrete share portfolio, which is managed by us. We have partnered with Linear Asset Management, who are backed by the ANZ Bank for cash management, and JP Morgan, one of the biggest banks in the world, as custodian of your assets. We feel that this structure is the gold standard for your financial protection. In addition to this, we offer 19 separate and individual ethical screens that you can use to help tailor your investment, to ensure that your money is not being used to support companies that deal in areas and practices that you feel are important. By eliminating the areas that are only important to you, you keep the potential for higher returning areas that you might otherwise be ambivalent about, and these would typically be ruled out in broader ethical products currently available in the market. The name Nucleus comes from our ability to provide the core holdings of a client's portfolio, allowing them the time to explore areas that may be of interest or they may have experience in. We also offer a complete investment solution for those who don't have time to coordinate their own investments. Our investment team has decades of experience in world markets, and we have access to a global team of stock analysts. By removing the layers of middlemen that typically sit between your money and the markets, we've been able to reduce fees and provide unparalleled transparency in the solution we provide. For more information on what we can do for you, please call 1300 623 863 or contact us through www.nucleuswealth.com. Okay, so if you like that one, I certainly got an absolute mountain of information out of that one, and I hope you did too. Stay tuned for the next one. So same bat time, same bat channel, 30th of August at 12:30 p.m. Australian Eastern Standard Time. We're looking at the how-to of international investment. So probably one of the jewels in the crown of the Nucleus Wealth and MB Fund offering is our prowess in international investments, and through the course of the webinar, we'll be showing you how we do it. So if you're interested in that one, head over to proton.nucleuswealth.com and register your interest, and that can keep you abreast of all developments on that one. Look forward to seeing you then. As always, we are available on iTunes and Podcast Addict, and you can head over to bit.ly/Nucleus Insights for information there. If you like what you hear, please feel free to give us a review and some stars there as well. What it does is help drive us up the lists in terms of getting our exposure out there and getting in front of more people. So that'd be much appreciated. And as always, thanks for attending. You can head over to, once again, the bit.ly Nucleus survey for our survey our survey page to give us a little bit of feedback on how we've gone today. Sorry about the technical difficulties there. We've fix that up. And also, excuse me, as always, you can pop in some topics that you would like to hear about going forward. So on that note, a bit of a power session on the wonders and I guess the opportunities that are available out there for the nervous investor. Please be in touch if anything is of interest to you, or you'd like to hear more on a more personal level. Other than that, we'll look forward to catching you at the next one. Cheers.